Greetings and welcome. I'm Professor Denver, and thanks for checking out my presentation on basic accounting in alignment with the chapters in my book, Accounting 101, Easy Accounting and Bookkeeping for Beginners. This session is about concepts presented in Chapter 1, must-read overview of accounting and bookkeeping, and will briefly discuss some fundamental ideas upon which the accounting activities and concepts are built, and includes the concept of business entity or firm, business transactions, cash and non-cash transactions, the double entry system, and most important, the accounting equation. A business entity is a firm or organization formed or started by individuals or other firms to generate income or profits or other specified objectives through operating activities by the firm. They can be as simple as a sole proprietor going into business for himself or herself, located in a room or basement of a home, a store or shop, online store using computer resources, a business organized by several investors as partnerships, LLC, limited liability corporations, S corporations, designated under federal tax code as a special type of C Corp, or C corporation registered with the Secretary of State, among other variations of business entities. The financial and operating activities must be recognized, recorded, and reported separately from the personal financial activities of the owners of the business. Four popular types of business entities are: 1. General merchandise firms that trade in finished products through purchase and sale, such as retailers and general wholesalers. 2. Service firms that provide services to the public for a fee, such as banks, attorneys, doctors, accountants, investment firms, auto appliance servicing, landscaping, etc. 3. Manufacturing firms that produce goods by converting raw materials, labor, and overhead resources into products. And 4. Hybrid manufacturing and trading firms organized to produce, service, and sell products at a profit. Business transactions are transactions completed on behalf of a business entity and is usually evidenced by a receipt of the product or services, along with a receipt or invoice showing the exchange. Personal transactions are not recorded in the firm's accounting records. Receipts and invoices. When products or services are purchased for a business, the seller or vendor provides a receipt and/or invoice to the purchaser, typically showing the seller's name, address, and telephone number, the type and the quantity of the items purchased, along with unit price and the total amount in dollars or other currency, and the payment received in cash or credit card for cash transactions, or invoiced to the purchaser customer, showing receipt of the items and due date for payment for items sold on terms to the purchaser. Purchases on terms are usually accompanied by a signed purchase order from the customer and a bill of sale signed by the customer acknowledging receipt of the goods or services from the seller or vendor. Cash transactions are business transactions completed through the immediate payment or receipt of cash by the firm, such as buying or selling products or services for cash. This type of transaction involves the cash or bank account during the exchange. Non-cash or transactions on credit or terms involves deferring or settling business transactions at a future date, such as receipt or payment on terms, for example in 30 or 90 days. This involves the use of accounts receivable general ledger accounts to record future receipt of cash from customers for sales on credit, also called sales on account. and accounts payable ledger accounts for recording future payments of cash by the firm to suppliers and vendors for various materials and services purchased by the firm on credit terms. The double entry concept of accounting requires that business transactions consist of debits and equal amounts of credits, showing the equal sources and uses of funds between general ledger accounts using the chart of accounts. In other words, every transaction has an equal movement of value to debit, a receiving general ledger, from or credit, a source general ledger account, to properly record the transactions in journal entries. If we subtract all the credit entries from all the debit entries in a journal, the result must be 0 if recorded correctly. The journal entries are posted periodically to the corresponding general ledger accounts indicated in the journal. It is important for learners to fully understand the mechanics and reasons associated with making a simple journal using the double entry concept of debit and credit and the relevant general ledger accounts indicated in the chart of accounts. Hint: whenever a transaction's narrative contains a word cash or check or phrase such as paid to or received money from, one of the general ledger accounts in the transaction is the cash account. The accounting equation is based on the same double entry system of accounting used for recording transactions in the journal and provides a summary of all amounts posted in general ledger accounts in a simple formula. Total assets A is equal to the total of liabilities L plus the total of owner's equity E, or simply A equals L plus E. Tangible and intangible economic resources owned by a business are its assets. The amounts owed to creditors are debts of the business and are called liabilities. The amount of assets remaining after deducting liabilities and controlled by owners and investors in the business are called owner's equity. The equation assets equals liabilities plus owner's equity is called the accounting equation. General ledger accounts for assets usually have debit balances, and the ledger accounts for liabilities and owner's equity or capital normally have credit balances. It is called an equation because of the double entry system of accounting concept in the previous section, where the total of the accounts with debit balances must equal the total of the accounts with credit balances. The equation is the basis for a firm's balance sheet at a specific date. A quick look at any balance sheet will show different asset classes and a total assets amount on one part of the balance sheet, and another section showing classes of liabilities and equities, followed by a combined total liabilities and equity amount, and the two sections' total amounts shown to be equal or in balance. That is all for now. Thanks for watching this presentation and have a great day.